So good morning, everybody. It is just a minute before 10 o'clock. We wanted to start a little early, just a touch early today, just to make sure that everything was working well. But I've got Lydia, our Chief Investment Officer, with me today. Say hi, Lydia.
Good morning.
So today is going to be our one of our quarterly discussions about investment performance and the markets and some thoughts about our own portfolios. And Lydia's responsibility as our chief investment officer is to be the head of our investment committee. Our investment committee meets twice a week. We have different purposes for each meeting. And we make some adjustments to our own investments along the way, but we do everything in house here, which I think is really beneficial. And Lydia spends a tremendous amount of time, and I always like to have her share some of the work she's doing and some of the thoughts about what's happened in the markets and and where it might be going. No crystal balls, of course, but and of course, the things that we talk about are for education. There are no recommendations to buy, sell, or hold any positions, and we won't be talking about individual positions. But Lydia has some slides she put together for us, and I'm anxious to see them. And then we'll go and see if there's any questions you have. Again, we can't answer specific questions about your own investments or specific holdings. If you want to have those kinds of discussions, you can reach out to us at questions@attleborowealth.com. And if you have at least $1 million in investment holdings and you want to schedule time to talk to me directly to see how we might be able to help you, you can go to our website at attleborowealth.com. Click the contact us button, and in there's a 15-minute discovery call. I'm happy to have that conversation. Excuse me. I wanted to share with you some upcoming events that we have before we get started. We have the Changing World of Retirement Planning starting tomorrow at Holy Family University. For some reasons, one of my favorite locations, mostly because it's right across the street from us, and it's very, very convenient. But that starts tomorrow, and then next Thursday at 6:30 to 9:30. And then we have a Tuesday series. So we have Thursdays and Tuesdays, and Tuesday is February 3rd to and February 10th. Both start at 6:30, go to 9:30, both classes. So these are series that you go to together, 6 hours in total, 3 hours a night. And I'll share with you that we are full. We already have waiting lists that happened already a couple weeks ago. So if you've signed up, we'll see you there. If you haven't, I'm sorry, but we don't have any more room for this one, and we'll have another one coming up uh, within a couple months. So okay, so let me just talk about the goals for listeners. So we want you to be inspired to make changes. So we do things differently, and we want you to appreciate that and understand that and be inspired by it to make changes. That's the whole purpose of these webinars, this education. Open your mind to different ways of thinking about planning and investing. Stay educated so that you feel confident in the plan and the strategies that are put in place. Update it so that you can make adjustments along the way. We want you to stay updated. We bring you these updates as often as we can, almost every week. So these things are really important, not only for your own planning journey, but also for those folks who are listening, who are working with us. We recognize that we do things differently than most. And, these check-ins and this constant education about how we lay out our investments, why we do these certain financial planning strategies, tax planning strategies is really, really important. Okay, so enough of me talking. Lydia is going to share a screen or her screen with you in a moment, and she's got a presentation to do. But do you have anything you want to say before we get started, Lydia?
Yeah. What I'd like to do is just take a little time to give you a little snapshot of what happened in the market last year before we get into the detail of it, because I think it helps to set that scene. And I
Sure.
know, Mark has done these meetings weekly, right? Giving you updates on what's going on. But I think it's helpful to look at the big picture
Yep.
to set that context. So last year, the US stock market measured by the S&P 500, which is the most widely used index to measure our stock market, was up 16%. International markets up double that, 32%, right? Typically, we're on an annualized historical basis, you see 7 to 8% come out of the equity market. So that's a strong year.
Yep.
US investment grade bonds up 7%, historically 4 to 6%. right? So strong bond markets. Money markets were high 3% to low 4% range, right? And that's fully principal protected for the most part, right? And that's pretty strong as well. Inflation, 2.5%. The Fed's target's about 2%. Unemployment, 4 to 4.5% range. Economists consider 4% full employment.
Yeah.
So that looked pretty good, right? And
Yeah.
the economy grew at a nice steady 2%. Well, I shouldn't say steady. There were some fluctuations during the quarters, but overall for the year, we're somewhere around 2. We haven't gotten that final number. We should get that in February. But overall, we're looking at a very strong year. I think the things we're thinking about, and I don't want this to be a spoiler alert, but just to give you some things as to think about as we go through the details of it. But things we're thinking about, interest rates, they came down a bit this year, right? The Federal Reserve reduced rates. I think we'll see some more of that next year. How does that impact CDs, money markets, savings accounts, right? We would expect those to go down as well, something to be mindful of if we see rates continue to go down. Valuations have been high, especially in tech and AI names. Um, Potentially we'll see, some of these returns moderate a little bit. 16% here, 32% overseas. Those are not typical numbers. So we may see those come down a bit. Geopolitical risk, we're dealing with various announcements and often unexpected uh, things like, the Greenland announcement, new tariffs, and things like that that really upset the markets. And often it's short-term volatility, but yet it's there and it's something that we could see pop up throughout the year going forward. So these are all things we think about all the time, you know. So what I thought I would do is I do want to share my screen to give you some visuals here on um, various components of the economy and also the financial markets to give you a little bit of historical context, a little bit more of a detailed view of what's been going on.
Okay.
Let
Sounds
me
great.
get that screen up here for you. That look okay? Can you see
Yep.
that, Mark?
I can see it. Thank you.
All right, great, great. So the first thing I want to talk about, when we think about the economy, we want to kind of step back and take a big picture view. And I think the first thing most folks think about is the growth of the economy, or GDP, gross domestic product. That's essentially what we produce as a nation, products, goods, and services. And in that is also, you can see the box at the top of that screen, um, exports, net exports. And if we look at the chart below, what we see here is the black line representing quarterly GDP for the last 3-ish years. But the last 3 bars represent last year and the 3 quarters that have been reported so far. And you see a lot of purple in those bars. And what that's representing is net exports, and you see a negative number there in the first quarter. Remember that there was the announcement regarding tariffs that the president wanted to talk about imposing with other countries, and that set off businesses to load up on inventory, right? So they were importing more than usual to get ahead of those tariffs. So we saw that affect the first quarter GDP, but then picked up pretty quickly after that. So second and third quarter, fairly strong and positive. For the year overall, I think I mentioned we're expecting, or the economists are expecting, around 2%. We'll get that initial number likely in February. But 2% for a mature, developed country like ours is fairly, I don't want to say strong, but it's a solid number. Once you start seeing 3%, then you're talking about um, the the economy creating new jobs and things like that. So we're seeing significantly more growth, but 2% is still a stable number.
Okay.
Um, I do want to touch on the light blue section in these bars. Uh, that represents the consumer. What the consumer, us, our spending is contributing to the economy. And you can see in the table above, the share of nominal GDP attributed to the consumer spending is 68%. That's over 2/3. That's very significant. Yesterday, we had an announcement that came out to talk about consumer confidence. And it came in at almost 12-year low.
Yeah,
Uh,
11 and a half year low.
yeah, very significant. What that means is, the consumer has such a big impact on growth in our economy that when the confidence is there, that impacts potentially spending. It impacts investment into the markets. It impacts uh, growth of the economy, right? And then that trickles down to what the Fed will do with rates, right? So it is a significant impact. And I think it's something we're going to have to see how it plays out. And I think investors and the economists are going to be very focused on the next reported number there. I'll move
Yeah, it
on
was, I
to,
was, so I'll just add, and I'm sorry if I said this already, but in prior to going live today, Lydia and I were, working through making sure everything was working. And we were talking about this report yesterday. I was reading the Reuters article that says U.S. consumer confidence dives to a more than 11 and a half year low. And I said, but Lydia, I look at the screen and the S&P 500 just, is the highest level ever. So a lot of these things don't make sense to me, right? And so we hear these, that sounds devastating. The consumers are concerned. That means they're potentially not buying as much as many goods, and certainly can affect housing and major purchases and things like that. But we look at the markets; they're extremely strong. Little down right now, but and next time I look, it could be completely different. But it's and we're going to talk more about how to apply that to your plan. But all this information is so important. Looking back, what happened last year and how that affected the markets and our thoughts about this year. But it's really shocking sometimes to see what little effect these big numbers can have. Does that make sense?
yeah, that's right. Um, we'll talk a little bit about inflation. Inflation has been, especially the last few years, a big factor in what the Federal Reserve is doing, how folks are, back to the consumer spending, and the impact that has on growth, as we mentioned. So you can see this chart representing historical inflation numbers, and you see a big spike in 2022. We all think
Sure.
it's very recent and still very fresh. You remember that big peak at 9% year over year inflation coming out of the pandemic, right?
Yeah.
We've seen that come down fairly significantly, um, still higher than where the Federal Reserve would like to see. The target's about 2% is where they'd like to see the economy as far as inflation. Um, I think, what we saw last year was anything between 2.5% and 3%. Um, we don't have the full year, but that's kind of where we would expect it to be. I think the thing to point out here is we see the inflation number going down. It's important to, and we know, because we go to the grocery store and we're buying things, we know prices have not gone down.
Right.
The rate of um, the rate of increase of prices has slowed. So that's what that means. And we're saying that inflation has come down. It's not prices going down, it's just the rate of the increase has slowed down. And that's what this chart is showing.
Yeah, we've all absorbed the incremental increases already, and we're still paying the higher prices for everything at the store, of course. And I think Some places we see it on a daily basis are gas prices, right? Because we drive by, we see it, we have to fill up our cars if you drive a gas vehicle, and that's more direct. But the embedded inflation is still there. That 9% is still there.
Yeah, that's right.
It hasn't decreased, and it's been there's another report I read either or heard yesterday or maybe even this morning that kind of caught my attention because they said it's been more than 5 years now of higher than desired inflation, and that's a good that's a significant period of time. We went so many years with low inflation, low interest rates that it's certainly a shakeup to be in a position where we're really having to work to manage. And you can say what you want about the Fed, but we've just to be where we are today is in a pretty good situation considering where we were just a few years ago. Understanding that we're in a global pandemic and there was certainly a lot going on, but that's a direct result. That 9% inflation is direct result of the significant cash inflow that came into the economy, $9 trillion infused into the economy in a short period of time. That's always going to drive up prices.
That's right. That
So it's
government stimulus, it helped
yeah,
us, but it also um, created this issue with
yeah,
inflation and
exactly.
the supply issues we had. There were a lot of factors that
Yes.
played into it. It was a very unusual time, as we all know.
Yep.
No. Um, the other, and again, this chart here focusing on the labor markets, you see some big spikes here, all pandemic related when we're looking at these spikes still, um, fairly recent when we really sit back and think about it.
Yes.
Um, the chart on the left is showing monthly job growth going back to 2022. um, Coming out of that pandemic, I think we all remember the labor shortage issues. I remember going to a CVS and there was no one working behind the counter. We
Right.
were just expected to self-checkout, which was interesting because you're like, people could just walk out here with stuff, but they didn't have the people to man the counters. So it was certainly an unusual time. We've certainly seen that come down and things normalize a bit. In fact, we're seeing recent months a bit of a dip. Um, so things have changed pretty quickly.
Yeah,
On
yeah. If I could just jump on that. So we talked about it when we were in Tampa at our company retreat. We talked about this a bit, and we're looking to add to our team, and we talked about the fact that I think it's BlackRock announced 500 layoffs. There was another, like maybe Chase announced 1,000 layoffs. So we're starting to see the cycle, the normal cycle that we see over times where we've got increases in hirings and then layoffs and so it is again surprising, but it reinforces our position of being defensively optimistic when we're in such a strong position economically from a growth point of view and certainly from a market growth point of view, coming out of such a devastating effect like the that we had with the pandemic and the political turmoil that's been involved ever since then, not just in the U.S. but globally. So that shows a lot of resilience in the markets and the economies, and I certainly hope it continues, right? But there are things that we can do as planners to help stabilize our foundation around that.
Yeah. So on the right-hand side here, the black line represents unemployment, the unemployment rate. Um, You can see the dotted black line, that is the average unemployment rate
Hmm.
over this period. We're looking at 1994 to the current. Um, on average, 5.5% unemployment over that
Hmm.
period.
Hmm.
Right now, well, as of November, 4.6%. We saw it spike up. You could see that big spike during the pandemic, came down very quickly, went to record low of just over 3%, and now we're back up at 4.5. Keep in mind, economists consider 4% full employment. Um, So we're not in a bad spot. We're in a fairly decent spot right now, but we are seeing it tick up. So something to be mindful of.
And Lydia, so today we get the announcement about interest rates, and I know that unemployment is one of the contributing factors to the Fed's decision of what they're going to do with interest rates. And the consensus seems to be that we're not going to see an increase during this meeting, right?
Yeah.
What are you hearing for the rest of the year, if you don't mind just sharing, if anything, if what do you think we're going to see for the rest of the year regarding
As
interest
far as
rates?
interest
As
rates,
regarding interest rates, yes.
yeah, let me slide here. We'll look at the rates. Um, We saw, just to give you a little context, last year the Fed reduced rates 3 times,
Mhm.
a quarter point each time for a total of 0.75% reduction in the Fed funds rate. This is the bank that
Yep.
the rate that banks charge each other, short-term loans overnight. Um, what I think economists are expecting or have priced into the markets is another 2, potentially 3 rate cuts. I think the expectation is that we may not see it see significant cuts next year, but
When you
it's
say
gonna.
I'm sorry, when you
I'm
say
sorry,
next year,
this year,
yeah,
this
yeah,
year,
yeah. Okay.
yeah.
Yeah.
I
It's
think
it's
that
January. It's almost
I
it's almost February.
know.
Yeah. Yeah.
I think that, so much can happen between now and the rest of the year that it's really hard to say how this will play out. But for
Mhm.
now, that is the expectation that we will see additional cuts, um, potentially 2 or 3 is what's been priced into the market.
Okay, so if I'm an individual investor, so we do things differently, right? But if I'm an individual investor and I say, okay, so I'm hearing 3 interest rate cuts planned for 2026 likely, right? Maybe 2, maybe 3. What does that mean for the markets? I'm not looking for again a crystal ball say keep shoveling into gold or pull out of gold or whatever. Again, this is not any recommendation to buy, sell, or hold any position. This is education. But what what should people be thinking about when interest rates are being cut, when we're seeing inflation tick up, or inflation being sticky, unemployment tick up. So what does that mean for an investor? What should an investor do with that information?
Well, I think things that you might expect to see when rates go down, right? The short-term rates will typically go down first, and then we may see longer rates come down, and follow that over a relatively short period of time. Um, I think if you own short-term instruments, CDs, money markets, um, things like that, you would expect that what you're getting as far as interest rates on those vehicles is going to come down as well. Bonds, longer term bonds, typically what you see is an inverse relationship for the price or the total return of the bond relative to what interest rates are doing. If interest rates are coming down, you would see bond prices tick up. And then typically total return, right, would follow that as well. The longer the bond, the longer maturity, the more impacted by interest rate changes those bonds will be. So you'll see positive uh, returns from bonds as rates go down. I think on the equity markets, what you tend to see is smaller cap names do better. Because remember, these small companies are more leveraged than these larger companies. And we've seen some of that already happen at the end of last year, right? We saw that rotation from large cap to small cap. And we've seen that continue in the first part of this year. And I think, those lower rates help smaller cap companies. So we may see that see that affected.
Yeah, that's interesting. So, and again, from our point of view, we follow the strategic asset allocation model. That's given a certain amount of risk, you get a certain amount of return. We think that that's been efficiently proven over time, and our portfolios are designed to be to be driven by the financial plan and when you're going to use them during your timeline using the account segmentation income plan that we've developed. But but all these when Lydia is talking about, well, small caps might be affected in a positive way. So smaller companies, because they have more leverage than larger companies, are more sensitive to interest rates. That again doesn't mean that it's a tactical shift. We've made few tactical shifts in our time with this firm. One being 2022 when we sold out of our bond portfolios. Knock on wood, that worked out to be a very good thing. But it's we follow the structure of strategic asset allocation. If you want to hear more about that, you can certainly look at other videos we have about that. And maybe we could do an education video about strategic asset allocation versus tactical allocation at some point, Lydia. That might be interesting.
Yeah, I
Uh,
mean, that's a great point because we we can talk about what we think will happen or what the
yep,
market expects to happen, but what actually happens, we don't know.
that's right.
And that's why it's important to diversify, right? You need to be invested for your specific allocation as far as when your cash needs are needed, and diversify across cash, bonds, stocks, international equities, right? You want to have that well-diversified portfolio because the reality is we don't know uh, how the market will play out next year. We can certainly make some um, educated, I don't want to say guesses, but that's kind of what this is, right? It's looking at what we know and making some assumptions and
Well, that's why we take the guesswork out of it, right? And so that's why
yeah.
we have the account segmentation income plan, because that really plugs in the ability for growth while addressing the needs that you have in the short term and helping to eliminate that risk of having to sell out of positions when the market's going against what you think might happen.
Right.
And there are very, very well funded, well staffed, well educated analysts around the world. BlackRock famously came out during the pandemic and said, we are overweight the European markets because we think that they're going to respond better to the pandemic than the US market. And it was the exact opposite. So obviously, their investors who followed that direction it didn't make out as well. But now we hear, and you're probably gonna have to jump around a little bit, but you talked about international markets, and I, I've been hearing a lot of talk again about the S&P 500, the S&P 500, the S&P 500, and I get it because we're coming off a couple of good years, really a few good years of the U.S. markets, the S&P 500, mostly driven by a handful of companies, and that's great. The But you can't forget about the global markets, and Lydia is going to talk about the returns of the global. If you said it used to be, I remember when I first got into this business, many years ago now, it went at a company called Payne Weber. There was a very well respected person in our office who was, top tier financial advisor who said, I don't invest in international markets because their accounting standards aren't what ours are in the U.S. And then that got just blown out during the tech bust because the tech bubble bust because we found out, in Enron, we found out the accounting standards weren't really being followed anyway for many companies. But still, people have that bias toward the U.S. markets, and it can really hurt you or really dampen your portfolio return and overall return. And this all drives to your retirement return. For most people, that's what they're investing for is their retirement and maybe some legacy planning. But when you just pigeonhole yourself to the something like the S&P 500, you increase the risk potentially of your portfolio, and you also limit the potential for returns. We had the lost decade that everybody knows about from 2000 to 2010. The S&P 500 returned exactly zero, where a well globally allocated portfolio was up about three times, right? About 300% over that period of time. But Lydia, I'll let you talk a little bit more about that.
Yeah, Mark, that's a great point. And I'll start by talking about the S&P 500 for a minute, because I think it's important now more than ever to diversify um, globally, because the S&P has become so concentrated. Um, if you look at the chart I'm showing you here, we address the what folks call the Magnificent Seven. It's seven large tech, mostly tech names that have dominated the returns and have grown so much that they've become such a big allocation uh, in the S&P 500. While there are 500 names, these make up a big big part of it. If you look at recent returns, the Mag 7, the Magnificent Seven, accounted for 63% of the returns in 2023. 55% in 2024, right? But we've seen that come down recently. You can see the chart on the right showing 2023, 24, and 25. Those are those individual names that we're talking about relative to the S&P overall in green. You see 23 was, NVIDIA just blew everything away, and then Meta was also very strong. You look at 2025 and it's a very different picture, but
Hmm.
there's such a big allocation now of the overall market that you're very concentrated, and the valuations have become so high that I think a poor earnings announcement, or something that impacts AI spending, or something like that can easily trigger a downturn in these names and bring the market down with it. So you have to think about investing beyond this, mid-cap names, small-cap names in US, but also globally. What we saw last year were really strong international markets, and we haven't seen that in a while. We've seen the US just dominate global markets for a while. In fact, if you look at the right-hand side of this page, you see this black line at the top showing this is global market capitalization. The black line represents the United States equity market. It makes up 64% of the world's market capitalization. And you see the rest of the world has come down because US has done so well, and a lot of it is attributed to few names. It's been fairly a concentrated
So
market.
that's interesting because capitalization is different than return too, right? So let's talk.
It
Go back to
is.
yep. Talk. Go back to the S&P 500 for a second, because talk a little bit about why these seven companies have been so dominant in the S&P 500. And so the S&P 500 is a what's called cap weighted, or the capitalization of the companies is cap weighted. There's also you have the ability to invest in the S&P 500 on an even weighted basis. But why are we seeing? Can you explain that cap weighted
Yeah,
versus
yeah. Yeah,
it's not
so
even, it's not even weighted. I'm not thinking about the correct term's not coming to me, but explain why that's happening, please.
yes. So these market indexes, not all of them, but the S&P is, it's market capitalization weighted,
Right.
meaning the larger the valuation of the company, the larger position it makes up of the total index, right? So as the price goes up on these stocks, the size of the company overall gets bigger and bigger. Then they make up a bigger percentage of the index, right? So as
Right.
NVIDIA grew and grew, it became a much larger allocation of the index overall, right? There are indexes out there that are equal weighted, which means
Yes.
that,
Equal. There you go.
every,
That's the word I was looking for.
yeah, they're just if there's 500 stocks,
Yeah.
each one of them makes up 1/500th of the index. And as the capitalization changes, it doesn't change the weight. But that's not how most indexes are constructed. Most are market cap weighted. So as these companies grow and just become, they become a dominant weight in these indexes. And they, if they do have a negative year, it becomes a really big impact on the index overall.
So as an example, I just pulled up the weightings while we were talking here, and Nvidia is 7.37% of the S&P 500. The next closest is Apple at almost 6%, and I can just name the top seven, right? Microsoft, Amazon, Google, in two different share classes is 3.32 and 3.09. Meta and then Meta is 2.69. So remember, Nvidia is 7.37% of the S&P 500. That's the weighting. If I go down to number 500 here, number five, I'm getting there. I'm scrolling all the way down. Number 500 is Davita, and that is 0.01%. 0.01%. So that's a big difference, right? People think they have, then you do have representation of 500 different companies in the S&P 500, but you can see how the weightings really, really change. And if suddenly, Nvidia turns a corner that's not a good one, we could see a significant drop in the S&P 500. And that's why we have these big swings. That's why we'll see, a positive, significantly positive year, and then the market can drop 30% at any given time, any index, and that's one of the reasons is the way they get so heavily weighted to one company in one area of the market. Nvidia, Apple, Microsoft, Amazon, Google, two different share classes, Alphabet, two different share classes, and Meta, all on the same industry, all driven by.
That's right. That's right. That's a good
Right.
point, right?
Yep.
These are all big tech names. They're
Yep.
all
Yep.
driven by similar things.
That's right.
So you may not be as concentrated, or excuse me, you may not be as diversified as you think, because as
Correct.
Mark said, you think you have 500 names, and you do, but the allocations are so significantly different at the top versus the
Yep.
bottom of that list.
Okay, thank you. I think that's helpful to everyone to understand that cap weighting and why that's so important.
Yeah, so back to the global market. So we talk
Mhm.
about the global markets and capitalization basis as well, right? So as the US market has gone up so much in the last few years, it's become a bigger component of the overall equity markets globally. And there's concerns around valuation because of that. There's concerns about concentration, which we talked about, as far as, a few names really drive performance there. It's important to look at the rest of the world. I think last year, I think the international markets got a lot of attention from folks because of the strong returns that we saw. The EFA index is commonly referred to as, a barometer for international markets, up 32% last year. For us as US investors investing overseas, not only are we exposed to the stocks overseas, but the currency that we're using to buy those stocks, right?
Yes.
You think about it, you have to, if you're a US investor, you have to buy um, yen or euro or whatever denomination those stocks are in. So you have return on the stocks, but you also have return on the currency, right? So for us as US investors, we had even stronger returns because those currencies were strong relative to the dollar last year. You can see on this chart the EFA index in local terms, right? If you're not converting the currency as well, was up 21%. So we ended up with a 32% return because we also had the appreciation in the currency for those countries. Not only, so EFA is developed countries, the big European and Asian countries, but Emerging markets also, for many years, emerging markets didn't do much. It was, lagging behind. We saw a really strong year last year of 34%. Um, we're seeing that continue this year so far. We're seeing a similar picture with the international markets, fairly strong.
So where individuals and frankly even professionals often fail in their investment structure and investment planning is they'll look back on what happened last year and they'll say, well, geez, look how well the IFA did. Let's overweight. Let's put a bunch of money into that. So you're going to share the quilt chart in a moment, but I think I think I remember that's in your presentation.
Yes,
But
it's next. It's coming
yeah,
up next.
okay.
Good timing.
But you know that where individuals and professionals fail is they they switch allocations around too much and they miss opportunities like the ones that we had internationally and even in the U.S. markets last year by tactically trying to jump all over the quilt chart that Lydia is going to share with you in a moment, trying to maximize your return, and it typically works out to be the other way. So and that harkens back to strategic asset allocation. So Lydia, I'll let you go to the next chart when you're ready, and you can talk about that.
Yeah, so I think by looking at this, you might know why we're calling it a quilt chart, right? It looks like a quilt with all these colors. What this chart is showing you is the first two columns there are taking various asset classes from cash to commodities to um, US small cap, international, et cetera, and looking at the first column is showing annualized returns for each of those market segments. The second column is showing the volatility of each of those over that. This is a 15-year period annualized. And then the rest of these columns are showing calendar year performance for each of these. And I think what you'll notice if you pick a color, say the orange, right, small cap, 2013, it's at the top of the list. If we look at 2015, just 2 years later, it's near the bottom of the list.
Mm-hmm.
Um, right? And even things like cash in 2018, cash was at the top of the list. In 2019, it's at the bottom of the list.
Yeah.
It's I don't want to say it's difficult. I think it's more like impossible to know what's
Yeah.
going to happen each year, right? So I think if you look at the white boxes kind of clustered in the middle of this chart, we're looking at an asset allocation portfolio, a portfolio that's diversified across asset classes. This is a 60% equity stocks and 40% fixed income or bond portfolio. What you
Again, this is
find,
I'm sorry, let me just jump in. This is an example, folks. This is not a recommendation for that to be your allocation. This is just
yeah,
an
that's
example
right. That's
of a
right.
60-40 portfolio and how it performed over time compared to the or highlighting the individual asset classes.
Yes, it's just an illustration to show how combining various asset classes can really change or smooth out your potential return over the years. And what you see here is that portfolio is never really at the top, but it's also never at the bottom. And I think the other thing is, you look at that portfolio and over that 15-year period, it returns 7.3%. That's a pretty good return for something that, has taken a lot of risk out by diversifying. Diversifying doesn't necessarily reduce return, it just reduces risk often. And I think that's what we can see here. Um, and I think this table is just showing the risk of selecting various asset classes and concentration or trying to determine which asset class is going to be the big performer next year. That's a very difficult thing to do. I don't know that many folks can do that well.
Well, almost all of them fail in it, right?
Yeah,
So
that's
that's what
right.
right. So
That's right.
that's what makes it challenging. So, and Lydia's talking about asset allocation, and you'll hear me talk about this at least one more time today. But remember that we've got the our three pillars of investment management. And first is, how do we even get to the point of investment management and how we fund things? And that is, it's the answer's got to be driven by a financial plan when you're going to need the funds. So we have the three pillars are asset allocation, and this is highlighting the importance of asset allocation. So having broadly diversified portfolio against across all asset classes, and then dialed in depending on your risk tolerances, but most importantly, when you're going to need those funds. So asset allocation, some level of principal protection, and we by principal protection I mean an investment that gives the opportunity for some growth, but also protects against the downside. So the worst you're going to have in any year is a zero return. So it erases that downside. And then
Right.
of course,
What
yeah,
I'd like to show, you're talking about, investing in principal protection early on. I think the next chart that I want to show here illustrates that really well. So let me jump to that while
can I
you're
can I just finish
talking.
and hit
Yeah,
my
yeah.
third pillar? So my first pillar was asset allocation. Second was principal protection, and then the third is the account segmentation income plan. And that's really those three. Those we find that those three pillars really help set that foundation for the your investment strategy. And of course, it has to be reviewed every year. But okay, thank you for indulging me.
Yeah, no, I just wanted to point to this because it goes right in line with what you were saying,
Yeah.
is that, you think about when you're going to need money from your portfolio, right? And you want to invest with that in mind. Because when you look at how the market performs, you see that over longer period of time, equity markets um, are fairly protected on the downside, but in the shorter term, there can be a lot of volatility, right? Um, and what this is showing is if you look at those green bars, they represent stocks, the blue represents bonds, and the gray represents, again, we're using an illustrative portfolio here, 60% stocks and 40% bonds in the dark gray over different periods. So that first section of bars, there is a 1 year period. You can see equity markets over this, we're looking at 1950 to 2025. So that's a long period of time.
Yeah.
What you find is that the highest equities have returned is 52% in 1 year, but they've also had a negative 37% in a year. And then you look at bonds and you're seeing that volatility come down pretty significantly. And then again, the diversified portfolio also protecting you quite a bit more than just that equity portfolio. But the interesting thing here is that once you move into a longer time period, a 5 year, 10 year, 20 year rolling period, you see the negative numbers go down significantly, right? It's almost to we see a 1% positive return in worst case scenario in the 20-year period. Now, this is historical data, right? Doesn't mean that's what we'll see going forward, but there's certainly a trend here, and you can see how that plays out. And that's why when we think about investing for our clients, it's important to know when you're going to need that money, right?
Yes.
And invest accordingly.
Yeah. Good.
Mhm.
That's helpful.
So again, I think what this shows is just having a simple balanced portfolio and a long time horizon um, is beneficial, and investing very conservatively for investments that you will need within a year to 3 years, let's say. Uh,
Yeah. So it's you've been with us about 6 months now. So how have you seen, and I didn't ask Lydia this ahead of time, so I hope I don't throw her a curveball here. But this is what we see here is very typical. So an investment firm will say, here's your risk tolerance from 1 to 10. Tell me, 1 being most conservative, 10 being most aggressive. And then they'll come up with something like this, a 60-40 portfolio, 70-30 portfolio. something like that. And they'll use slides like this. Look at how we're minimizing the risk. We keep it rebalanced, and all that is very, very important. I'm not minimizing that. Asset allocation is one of our pillars. It's important. But Lydia, when we take it to the next step and we do account segmentation, and that is we plug in specific accounts and portfolios, allocate it specifically when the funds are going to be needed. We called it asset liability matching in the pension world. But we've distilled that down for individual investors. So now we say if you need $300,000 in the first 3 years, now until 3 years from now, we're going to have that in very secured investment. The later money is going to be invested with a later mindset, and we fan it out over your timeline. How do you think how has that changed for you about how you look at investment management, and how do you think that benefits the folks that we work with?
Yeah. Well, I will say, I spend a lot of time in the retirement world, and thinking about folks retiring and when they can retire and how much money they need, and all those things. And I think the big thing that always stood out was, yeah, it looks like you'll be okay. The problem is there's this issue of time series of returns.
Yeah.
Okay, if you retire next year and the market goes down significantly, your outlook over the next 30 years is significantly different if you start pulling from your portfolio in a down market. I mean, it's dramatically different.
Yeah.
I think this time segmentation approach eliminates that issue. It's one of the biggest issues that retirees face.
Hmm.
Yeah, and I think, when I spoke with you, that was one thing that really drew me to this firm is, I just coming from that retirement world, I know that that was always one of the big issues that you could retire, but what if the market turns? We don't know, right? That's an unknown and a big risk. And this kind of takes that off the table.
Yeah. Good. All right. We've got about 10 minutes left. What would you like? How would you like to finish here?
Well, I don't know if it would it be helpful to talk a little bit about things that we've done this year and what we're
Yes,
thinking about
that'd be great.
with our portfolios. So, some of
Yeah, I'll
the
just
things,
remind you, I know we talked about it, but I'll just remind you that this is not a client-only broadcast. This is a public broadcast. So we're not going to talk about specific investments. We're going to talk at a very high level. We can talk about some things that we do to manage the risk and build portfolios, but we're not going to say, we're using XYZ fund and we're not using a fund that's XYZ, by the
yeah, that's right. That's right.
way.
I'll just speak in broad terms,
Okay.
but just to give you a little sense, we did things like reduce cash allocations. With rates coming down, we want to be really mindful of making sure that clients are getting as much as they can from their short-term investments. And that doesn't mean taking risk. It means just investing a little bit smarter with some of the money and just reducing that cash allocation, moving it into things like money markets where you may get a higher yield, but that principal protection is still there.
Yeah.
Um, we looked at ways to reduce expenses. I think that's something that's really important. It's a way to ensure additional return, right? With that doesn't cost you anything from a risk standpoint. It's just taking away some of those expenses. We found some ways to do that this year, which I think were great. Um, we sold a position that I think did really well for our clients for many years. But we saw signs that there was some possible deterioration in their fundamentals. So we removed that position and moved it into a similar position that was better supported by the underlying investment in that company. So I think that worked out really well.
Let me comment on that for a second, because we talk about these two investment committee meetings a week that we have, and there's a couple of things that we do, and you can talk about this a little bit more. But one of the meetings we go over a cash report, and that goes around to the team, and there's kind of a monthly cash report, but it's also reviewed on a regular, throughout the month, and that's to make sure that we're not we're doing everything we can not to have large cash holdings that are producing, small interest returns. We want to maximize that interest that we have for our clients, and also making sure that we're allocating as we should. There's everybody, I've heard it over and over again, and I see it from people, who come to us. I've had $500,000 sitting at XYZ and I'm getting 0.05%, and so we work really hard to make sure that that's not being happening or not happening. And it is of course a process, because Lydia will submit the cash report to everybody, and Jessica, for example, will say, all right, well, yeah, I know there's $35,000 sitting in this account, but I'm distributing that to the client in 2 days. So don't reinvest that. I still need that money. So this spreadsheet will have notes from everybody. So just to give you folks some ideas of what happens on a regular basis among the team that you probably don't know about. The other part is, we look at portfolio holdings. Now, again, we're meeting twice a week, and which I don't think anybody else does, but we're meeting twice a week to go over these things. And one of them was this issue that we identified over the summer, I guess it was, or late or coming into the fall. And as Lydia said, it was a very good holding for us for many, many, going back to about 2011, 2012. And it was just, we had some concerns about it, and it turned out to be valid concerns. But we switched out of the holding into another one like investment, but and a little bit less of a dividend yield, but a much more stable investment in our opinion. And that's the work that we're able to do in the background. That's just an example. We are not capricious at all about the investments that we're holding. We don't flop in and out of different ones. Lydia is very sensitive to fees. She spent a lot of years at Vanguard. We use a lot of Vanguard holdings in our portfolios because they're cheaper and efficient, and we like that. But that's I just want to share some of the things that go on behind the scenes. So go ahead and continue, Lydia. We've got about 4 minutes left.
Yeah, so I'll touch on just a couple other things that we did last year. We moved out of a municipal bond mutual fund holding, which are, they're great, but I think ETFs do a better job of controlling capital gain distributions. If you're in a municipal bond holding, you're sensitive to taxes, right?
Yep.
So moving into ETFs, we were able to eliminate unintended capital gain distributions. Also moved from passive to active in that space. I think that is helpful there too, because that is a segment where an active manager can really manage those income exposures more effectively.
So that was if I'm remembering correctly, that was a municipal index fund. Is that right?
That's right.
Yeah.
That's right. It was a municipal municipal fund.
Index fund.
Index fund, yes.
Yeah.
So we moved that to an ETF, actively managed fund.
Yeah.
Right. And I think in doing that, we even eliminated some transaction fees. So it was
Yes.
like really a win-win. That I thought that was a, really worthwhile change.
Yeah, and the average consumer out there will just hear, because they've heard it from Susie Orman, and just buy index funds, index mutual funds, and it's not always the answer. And
Right.
we have few mutual funds. How many, if you know, how many mutual funds are we using now?
Oh, geez, we probably have
3.
I was going to say 3 or 4. Yeah, something
Yeah.
in that ballpark. Yeah.
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 Yeah. Okay.
And
Yeah, because there are, as Lydia said, there are actively managed ETFs and there are buffered ETF. There's the ETF space has become very, very rich with options. You have to be careful,
Yes.
and you have to do your evaluations just like anything else. You can see vast differences between the comparable S&P 500 ETFs as far as return, costs, efficiencies. So you've got to be careful, but there's a lot that can be done.
Yeah. Now I'll mention one other change we made last year was moving out of an overweight large cap growth actively managed mutual fund, which was really tech heavy and did well, right? It was a great area of the market, did well, but it just because they do well, sometimes they just become overweighted.
Hmm.
in our client portfolios. So it was a good time to reduce that position, and we moved into smaller cap names, more value oriented. And the timing was around, I guess it was late in the year. It was probably September-ish timeframe. It worked out really well because the market did turn and small caps did start to outperform. So that worked out really well for us. And we're continuing to see that this year. So that was, a change that worked out well for us. And just the
So,
last two.
so let me comment on that because again, that was not a tactical move. We didn't say, okay, we're going to reallocate out of large size companies into smaller size companies. That was a rebalance. That was a
Yes,
strategic
that's
asset
right.
allocation rebalance. Now we've had so much growth in the large cap space. This happens, and then we spin off to bring it back down to what the weighting should be and reallocate it into under allocated areas of the portfolio.
Yeah.
And we're doing that for across all the portfolio allocations we have. From our segment one to segment five to segment the legacy longevity. So six different portfolios plus some custom portfolios plus a retirement focused portfolios. So I'm talking about what we call qualified IRAs, Roth IRAs, and then we have tax sensitive portfolios. So there's a lot going on with these individual portfolios, and then we lay them over the schedule, the account segmentation schedule, which is driven by the plan, and that is constantly updated as well.
Yeah. And I'll just wrap up by saying, I think this year, what we want to look at, I mean, there's going to be other things that come up through the year, but
Yeah.
initially, what we're thinking about is interest rates potentially going down and looking at that most conservative portfolio, which is allocated towards just principal protected interest bearing type of investment vehicles, and thinking about how we can find ways to add a little bit more yield there without compromising that principal protection. Um, we're also looking at some private equity and private debt investments, which are not for everyone, but there are a few clients that might benefit from those type of investments. They have certain requirement for investors. They do have some limited liquidity where your money may be locked up. And like I said, that's not for everyone, but there are things that we're evaluating. Um, and I'll say just this week we were looking at some funds that can help folks with large concentrations in stocks with big gains, where they may not want to sell it and take those gains. There are some innovative products out there that can help you diversify that without taking that gain immediately, potentially deferring that. So there's some interesting things out there that we want to make sure we're at least aware of that are available if clients do need them.
Yeah, and I'll share with you that one of the things that Lydia does is, so I had asked her specifically to look into these. They're called exchange funds. So when you have a large position, you can exchange into a fund that diversifies that large position, and you can defer capital gains tax on that when we're talking about outside of an IRA. So if there's just so many examples where you could have very, very small basis, and now you have $1 million in one position that you need to reallocate. Um, so Lydia did some great analysis and then starts pulling people into the office, right? We've got a person coming in tomorrow from one of these funds to go over some details for due diligence. So she makes them get on a plane or drive here to visit us. All right, Lydia, that was great. We've got a couple questions. And a lot of good mornings. Hello, everybody. I appreciate the hellos from the team and everybody else. Jack asks, what frequency is the weighting done? Daily, real time? I think he's referring to the S&P 500.
Oh,
Uh,
that is real time. I mean, the pricing on those stocks changes constantly. So those capitalizations change, and the Standard and Poor's is the company that does that, and
yeah,
that's constantly being
yeah.
updated.
And if you're talking so what I read to you about the weighting. So that was probably as of the close of business yesterday, right? I'm guessing, 'cause just from the resource I had. The I think it was Slick Charts or Y Charts, but And Jack might have been talking about the rebalancing the S&P 500. I think that's a quarterly rebalance. Is that right?
I'm not sure how often they actually
Yeah,
rebalance.
I think it's a quarterly, but we'll talk about that. There is a curveball. I'm sorry. Uh, Roseanne writes, the weighting of the companies in the S&P 500 cap weightings was interesting and eye-opening. I appreciate that. Thank you. Jesse says this was incredibly informative. Thanks for the market summary in particular. Yeah, this was great, Lydia, and well prepared and well done as always. I think it's helpful to see, your thoughts and for folks to have some more insight about what we're doing every single day. I want to remind you that we've got these webinars that are available on our website. We've got the podcast, Not a Guru, Real Financial Education Podcast. We see that increase every day. If you have somebody who we should talk to or should learn about these, feel free to share that podcast information, share the YouTube information. If you're not already a subscriber, hit the subscribe, like, and notification buttons so that you get your notifications. We also repackaged this webinar from today and take out the ums and the ahs and the different things that we have to edit. And then we send it out as a recording because not everybody can be available on a Wednesday morning. But even if they're not working, they're playing pickleball or doing all the things you love to do in retirement. But if you want to make sure that you don't miss a video, you can get on our mailing list or email list. So you can email us at questions@attleborowealth.com. That's questions at attleborowealth.com, or go to our website, attleborowealth.com. And there's several different ways that you can sign up to be on our distribution list. I hope this was helpful, and I hope you learned a lot, and I hope to see you soon. Have a great week. Take care.